right, how's it going, guys? So today we are setting up an analysis to kind of just determine the cost of equity for three very different companies. So Cloud Tech, Regional Bancorp, and Green Energy Utilities. So as an analyst, for our firm, we need to kind of establish a clear hurdle rate for these potential investments, and provide some strategic advice for or to our high growth target, Cloud Tech. So kind of going to conduct this analysis in like a macro econ environment. So we'll kind of go into part one of our code here. And we'll kind of look at the start, and kind of the first step like we have is to kind of define the parameters for our analysis with the discover phase. So we've kind of set the risk-free rate at 4.5%, and based on the 10-year treasury. So this is kind of just the baseline return any investor would demand for a risk-free investment. And we've defined the market risk premium at 6%, and this is kind of the additional return investors demand on average to invest in the stock market, like S&P 500, instead of risk-free assets. So finally, we've loaded our company-specific data into a data frame, and you can see kind of the distinct profiles of Cloud Tech and Regional Bancorp and Green Energy Utilities. So section 2, we kind of look at with kind of our data loaded. Move to the core calculation. So we kind of implemented the capital asset pricing model, or the CAPM, which is kind of like a foundational tool for what we're trying to do. The formula is kind of straightforward. So it's cost of equity is equal to the risk-free rate plus the company's beta multiplied by the market risk. So we've kind of defined a Python function to apply this formula. And when we kind of run it against our data frame, we get our first set of critical results that we will see below. Excuse me. So we will go on to section 3. Excuse me. And the numbers are good, but we kind of need a visual representation to make the risk return trade-off a lot clearer for you guys to see. So our next block of code is kind of just the matplotlib to plot the security market line, or the SML. And so we're kind of generating based off the CAPM. So the y-axis is going to be the required rate of return, and the x-axis is the systematic risk, or beta. So you can kind of see the line. We'll kind of show later where it starts and kind of where it goes. But after that, before that, we will go to section 4. So the baseline numbers are just kind of a snapshot. We know the market is volatile. Our represent phase demanded. We model this kind of uncertainty in the market. So our next code section is kind of performing a crucial scenario analysis. And we modeled 2 key risks facing our firm, which are recession and a Fed rate hike. So the recession is kind of just investors becoming more risk averse, and the premium, or the market risk premium, the MRP, increases, and we've kind of modeled it from going to 6 to 8%. And then for our second scenario, we kind of have shown that the inflation, as it remains high, the Fed may raise rates even further. So we're going to show that increases to 5.5%. So we will kind of go to our output, and see each, like we were showing in our output, that each company, the beta is, at least with CloudTech, double Regional Bancorp, and Green Energy Utilities is just 0.5, which is, and CloudTech is over 3 times the Green Energy Utilities, and the cost of equity is kind of similar to the beta. So we're kind of able to see here just how the numbers are showing each different company, how they're able to, with the market increasing and the rates kind of going up, how the beta is affected with the CAPM and the cost of equity. And so we kind of, like we were saying, going through, kind of started with the parameters and then kind of found our beta, and then just kind of went from there. So let's go ahead and see here the graph. So we can kind of see within the graph that with, like we said, the y-axis being the required rate of return, x-axis being the systematic risk. So you can kind of see that the line kind of starts at 4.5%. That's our risk-free rate, where beta is 0. And the line kind of slopes upward about 6%. And that's our slope, which is our kind of our market risk premium. And most importantly, you can kind of see through our 3 companies plotted that they're directly on this line, kind of visualizing the story, where Green Energy is kind of down here in low risk. And then way up here, you kind of see CloudTech, which requires a return more than double than that of the utility to compensate for its high systematic risk. So this kind of confirms our calculations are verified and correctly plotted. And that is kind of it that we have done today. To kind of wrap up here, just saying that the reason for CloudTech's high beta lies in its business model. Its revenues are kind of tied to cyclical IT budgets, and its high fixed costs create kind of significant operating leverage. Green Energy, which is a regulated utility, has the exact opposite model, a non-cyclical, predictable cash flow. So for CloudTech, its 15.3% cost of equity is a major hurdle. So to kind of lower it, our analysis points to 2 strategies to kind of leave you with. So operationally and financially. So they must kind of de-risk their revenue first. This means like shifting focus from volatile new customer sales to stable long-term enterprise contracts and building predictable recurring revenue. And financially, while they're kind of 100% equity financed now, adding a modest strategic amount of low-cost debt could actually lower their overall weighted average cost of capital, or WACC. So finally, kind of just acknowledge the limitations of the CAPM as kind of our evolve step in driver. And CAPM is kind of a single factor model. It ignores other risks, especially the like company-specific risks of a private startup, and like things like technology risk or things of that nature. So therefore, our final recommendation, after everything that is considered, is to the firm that is like 15.3% should be considered like the absolute minimum floor for our hurdle rate. A more realistic rate, kind of using a VC specific like build up model that adds premiums for size and startup risk, is likely closer to 18 to 20%. So after all of that, that is kind of all of our data that we have within our code and our output. And we will see you guys in the next video. Thank you.